Passive income has become one of the most powerful ideas in modern investing. The promise is simple. Buy a few rental properties, collect rent every month, and let the income replace your job. And eventually financial freedom arrives. But if you talk privately with many rental property investors, you often hear a very different story. They own properties, sometimes several of them, and yet the passive income they expected never fully materializes. Cash flow is inconsistent, repairs appear unexpectedly, vacancies interrupt income, and the portfolio that once looked like a path to financial freedom starts to feel more like a second job. So the real question isn't whether rental properties can produce passive income. They absolutely can. But the real question is this: why do so many investors own rental properties but still struggle to build durable passive income? Because once you understand the answer to that question, you start to see real estate investing very differently. If we haven't met yet, my name is Adam Williams. I'm the founder of LFS Capital, and for more than 2 decades, I've been investing in multifamily real estate. Over the past year alone, our team has been involved in more than $200 million in multifamily transactions, adding over 1,300 units to our portfolio. Over that time, I've worked with thousands of investors, from first-time property owners to experienced professionals. And one of the most common misconceptions I see is the assumption that simply owning rental properties automatically creates passive income. In reality, the structure of the investment matters far more than the number of properties owned. Many investors begin their real estate journey with a very simple strategy. Buy a property, rent it out, collect the difference between the rents and the expenses, and then repeat. And during strong housing markets, this approach can appear to work quite well. Property values rise, equity grows, cash flow appears stable, but over time, something subtle begins to happen. The investor realizes the portfolio isn't actually producing the level of income they expected. Repairs consume profits, vacancies interrupt revenue, insurance premiums rise, property taxes increase, and suddenly, a property that was supposed to produce $400 a month produces $150 or sometimes nothing at all. When this happens across multiple properties, the portfolio stops behaving like an income engine. It behaves like a collection of fragile assets. And that difference becomes incredibly important during uncertain markets. Because the biggest mistake most rental property investors make isn't choosing the wrong property. It's believing that property ownership alone creates passive income. In reality, passive income comes from something much deeper than that. Let's look at a realistic example. An investor buys 3 rental homes. Each property costs $450,000. They put down 20%. The capital invested is $270,000. Each property rents for $2,400 a month. After mortgage payments, taxes, insurance, and maintenance, the investor expects roughly $350 a month in cash flow per property. Across 3 properties, that looks like $1,050 per month. And that sounds promising. But now introduce a few very common realities. One property experiences a 2-month vacancy. Another requires a $9,000 roof replacement. Insurance premiums increase by $200 a month across the portfolio. And suddenly, the annual numbers look very different. Instead of producing $12,600 in yearly income, the portfolio might only produce $3,000 to $4,000 or even less, which means the investor committed $270,000 of capital to generate income that may not even replace a single utility bill each month. And this is where many investors begin to realize something uncomfortable. Owning property and building income systems are 2 very different things. The investors who successfully build passive income through real estate rarely focus on property count. They focus on income durability, and that distinction changes everything. Professional investors tend to evaluate real estate deals very differently than individual property buyers. Instead of focusing on the number of assets owned, they focus on the income characteristics of the portfolio itself. Large multifamily properties often create efficiencies that smaller portfolios cannot. Operating costs can be distributed across many units. Vacancy risk becomes diversified. Property management systems become viable. And the income stream becomes far more predictable, which allows the portfolio to behave less like a group of individual properties and more like a structured income-producing asset. But before we go any further, it's worth pausing on a question that almost no real estate investor asks themselves. Not what property should I buy next, but what type of investor am I actually becoming? Because after 2 decades in this business, I've noticed something very consistent. Most investors believe that building passive income, but when you really examine how their portfolios are structured, they're often playing a completely different game. And once you see this pattern, it becomes very difficult to unsee. Because in reality, real estate investors tend to operate at 3 very different levels. And the level you operate at will largely determine whether real estate becomes a durable income engine or simply a collection of properties that consistently demand your attention. Over the years, I've noticed something very interesting when I talk with real estate investors. Most people think they're pursuing passive income, but in reality, they're operating at very different levels of investing. And understanding these levels explains why some investors struggle for years, while others eventually build very durable income streams. Because in my experience, real estate investors tend to fall into 3 distinct categories. Level 1, property buyers. Property buyers focus primarily on the asset itself. They're looking for a good deal, a property in a strong neighborhood, a house that rents well, maybe a duplex or a small rental that seems like a smart purchase. And there's nothing inherently wrong with that approach. In fact, most everyone starts here. But property buyers are focused on an individual transaction, not income systems. Each purchase is evaluated individually, and each property stands on its own, which means each property also carries its own risks. If the tenant moves out, the income stops. If the roof fails, the profits disappear. And if the property requires consistent attention, the investment slowly begins to resemble a second job. Now that's level 1. Level 2 is portfolio builders. These investors begin to think more strategically. Instead of owning 1 or 2 properties, they want to build a collection of assets. 3 properties, 5 properties, maybe even 10. The goal becomes scale. More properties should mean more income. And sometimes it does. But something interesting often happens at this stage. The complexity of the portfolio begins to grow faster than the income. More roofs, more tenants, more repairs, more vacancies, more management decisions. And suddenly, the investor owns a larger portfolio, but they're also managing a larger system of problems. Now let's get to level 3. Income engineers. This is the level where passive income actually begins to emerge. Income engineers approach real estate very differently. They're not primarily focused on how many properties they own. They're focused on how the income is structured, and this is the key. They look for investments where the income stream itself is resilient, where vacancy in one unit does not eliminate their entire revenue stream, where professional management systems can operate efficiently, where operating costs can be distributed across many units instead of concentrated in one property, and where the income behaves more like a business than a collection of individual houses. This is one of the reasons why large multifamily properties tend to function differently than small rental portfolios. When you have 200 units, a single vacancy barely moves the numbers. But when you own one rental house, a vacancy reduces income by 100%. That structural difference changes everything. Income engineers understand something that many investors eventually learn the hard way. Passive income isn't created by accumulating properties. It's created by designing income systems that remain durable even when things go wrong. Because in real estate investing, things will always go wrong. Roofs will fail, tenants will move, costs will rise, and markets will shift. The investors who succeed long-term are the ones who design portfolios that can absorb those shocks without collapsing the entire income stream. And that's when the moment real estate investing starts to behave less like speculation and more like income engineering. After more than 2 decades investing in multifamily real estate, this is why I remain deeply committed to the asset class. Not because real estate is perfect, but because well-structured multifamily investments can create income streams that remain durable through changing market environments. And durability is what ultimately transforms investing from speculation to long-term wealth creation. At some point, every investor faces a decision. You can pursue real estate as a collection of individual property purchases, or you can design a portfolio designed to produce durable passive income. One approach accumulates assets, the other engineers income. And over time, the results between those 2 strategies tend to look very different. If you'd like to learn more about how we structure multifamily investments at LFS Capital, visit lfscapital.com and book a call with our team. We'll review your goals, evaluate your portfolio, and discuss the kind of income system you're trying to build to determine whether working together might make sense. My mission is to help people like you create real wealth and passive income through investing in multifamily real estate. It's how I built my family's fortune over the last 2 decades, and in my opinion, it's one of the most trusted ways to build lasting wealth. And in the next video, we're going to explore how professional investors analyze apartment deals before they ever invest $1. I'll see you there.